Andrew, it's lovely to see you. You're one of Australia's most successful fund managers. So you and Kerr started Platinum back in 1994. And I was surprised to hear you say recently that you felt like there are so many mispriced stocks that you're almost at a loss for trying to buy as many as you want to. Given there's so many uncertainties in the world, why do you feel that way?
So, I mean, it's actually all of those uncertainties that we're facing, the indebtedness around the world, the uncertainty of what a Trump presidency means, concerns about China and how they're managing their economy. All of these things, and it's been the case ever since 2008, we've lived in this period of uncertainty, and it's driven people to want to avoid risk. And it's driven them into things like fixed interest investments. It's driven them into consumer staples type shares, the Procter & Gamble's of the world, where people perceive there's low risk. And what it's done is it's driven the valuations apart between high certainty and anything that's perceived to have risk. And yet some of these companies, whether it's as a good example, a company like Samsung, a giant in its field, has grown at a rate of about 10% per annum over the last 6-7 years, profitable, has cash, and yet it trades on a P of 9 or so times earnings, even putting aside the recent problems they've had.
The exploding phone problems.
Exploding phones. But even there, if you look at that is a $5 billion, $7 billion recall in the context of a company that's making over $20 billion a year. So it's not that it's not a problem, but here's a company. It's grown very nicely. It is cyclical, and yet up until 6 months ago, you can buy it on a P of 6 or 7 times earnings. Compared to a consumer staples business like Nestle that's not growing, but you have to pay 22 times.
And that's just because there's a predictability with a Nestle that there's not in a Samsung?
Absolutely. So people want predictability, and they're also getting the dividend yield because they're paying out all of their earnings. So you're getting a bit over 4% dividend yield. So people feel like they're getting that income and predictability. Whereas with a Samsung, you're just getting much better growth at a lower price, and the company is generating a lot of cash flow and starting through share buybacks and that increasing dividends themselves, starting to share that with shareholders.
You're an enthusiastic investor outside of the US, particularly through the Asian region, China, Japan and other parts of Asia, going all the way back into the 90s when you used to manage the BT Pacific Basin Fund. Do you think as Australian investors we overlook Asia as an investment destination?
I think Australians are pretty aware of Asia, and indeed, and because it's always been so important, to our resources sector and
as a
and
trading
whatever.
partner and as a hospitality.
Yep. So it's now education, hospitality, and also obviously a lot of inward investment now into property. So we're always very aware of it, but I think that we think of it very much in they're building roads and bridges and airports, and we think about steel and copper, but I don't think people are aware of the industries there, like insurance or their internet giants, pharmaceuticals. There's a whole range of industries that are growing very quickly there, and they are very sophisticated. They're not. I said, 25 years ago, 27 years ago, when I started investing in China, that meant going to Hong Kong and buying a company that made ceiling fans. That was China investing. Now we're talking about in the internet companies like Tencent or Alibaba or Baidu, buying into some of the most sophisticated technology companies in the world. Every part they're equal of the Googles and Amazons and Facebook. And so I think it's that, even in the financial world with insurance and life insurance, some of the companies there and what they're doing on, whether it's online services or, lending into small business and whatever, this is not as perhaps the Wild West as people think it is.
Well, it's really fascinating because it does have quite a juxtaposition to what the index looks like. So if you look at the composition of the broader international index for an Australian investor, China is quite a small part of that relative to, say, the US, which is at least 50% in most indices.
Yeah, so I think China, it depends on the index, but it's typically if 2% if you're lucky. And yet if you look at it in sort of global economic activity, I think we're talking more like probably like 12% versus the US's 20. And indeed, if you just look at the stock market is actually, more like 20% of the world's stock market opportunities. But people, many of those are listed in the exchanges of Shanghai and Shenzhen, which foreigners now can buy. I mean, the individual, if you have an account in Hong Kong, you can just go and buy shares in Shanghai, and we'll shortly be able to in Shenzhen as well. But there's a huge number of companies there that, our team, as they research them, each week you'll be coming up with a new company you haven't heard of, but it's not $100 million market capitalization, it's 6 or 7 billion US dollars. And, and very often some of these companies are trading very cheaply.
Well, it's fantastic, notwithstanding the fact that there's some real uncertainties on the horizon, that someone with your experience feels like there's still places for people to make money. So thank you.
Okay, thank you.